Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello and welcome back to the podcast. Thank you very much for coming back, for being here for the first time. Whatever, maybe you're binge listening. Kudos to you if you are binge listening. Okay, I have had a request. I've had several requests of topics, and they're not really long topics, so I'm going to join a couple of them together. And I just did a podcast not so long ago about when we're taking loans, do we charge ourselves more interest and where do we pay that? And let's be honest, you guys, I don't listen to my podcasts. So I record them. I don't 100% remember what I say because I turn the recorder on and I record. But I apparently said something that raised a lot of questions. Or perhaps I was confusing the matter. And so let me re-explain. When we take a loan, the question to me has been, Mary Jo, in your podcast, you talk about extra interest. What do we do with that extra interest? And normally I say what we do, but maybe I've missed it. But if you take a loan, and let's just use round numbers. If you take a loan and the insurance company charges you 5%, and you then want to be an honest banker and you want to pay that back at 7%. What do we do with the extra 2%? It does not go into your policy as a loan repayment. The extra 2% can't go in. When you take a policy loan, if you take a loan for $10,000, all you can put back is the $10,000, and then any interest of 5% in this example goes to the insurance company. So if you take a loan and you have extra interest, that has to go into the policy as premium payment. Premium can only fit if the policy is structured to hold the extra 2% without crossing that modified endowment contract. If it is going to become a MEC, then we can't put it in. And so what happens if I've already paid my premium in full and now I can't put any more in and I don't have room for it? Any extra interest may then go to a savings account until you have enough to start another policy. If you have multiple loans that you're paying interest on, maybe you have enough to start another policy with that. Some people might use it as a loan repayment in the future, right? Because now I have enough in savings, and so I'm going to use that to pay back a loan. Some people might use it if they're short 1 year to make a premium payment. You can use that however you want, but it may not fit in the policy. Now, that does not mean that you don't pay yourself back at 7%. No, that's not what that means. Oh, it doesn't fit in the policy. We paid our full premium. We can't get any extra in, so I'm not going to pay it. No. If you're going to be an honest banker, you need to still pay it and then be honest and put it in a savings account. And it should go, ideally, if you are being an honest banker, it should go into a new policy for premium payment. Or it should go in as premium above and beyond what you've already committed to pay. Because here's the deal. If your premium, let's just say your premium's $10,000 a year. You committed to $10,000 a year before you charged yourself 2% extra interest. So don't be like, oh, hey, guess what? I'm going to pay myself a little extra. Now I don't have to take it from the profits of the business. Oh, no. That's not being an honest banker. That's stinking thinking, right? That's thinking like how we used to think before we were introduced to the infinite banking concept. Or, I'm going to use it to pay a loan. Okay, so if you didn't have it, what would have you used to pay that loan? So yes, you can use it for those things, but it's also making you a lazy banker, not an honest banker. And we have to hold ourselves accountable. If we're going to take a loan, we need to pay it back just like we would have if we would have not had the extra interest. The extra interest is nothing more than forced savings that creates wealth. Interest to a bank does what? Creates wealth. It's the exact same thing. So don't be a lazy banker and say, I'm not going to put it in savings. I'm just going to use that as part of my premium. Now I don't have to come up with as much. Okay, so if you use the extra interest you were paying yourself, so you didn't have to come up with as much, on the other end, what did you do with the money you didn't have to come up with? You probably went and spent it on something else foolish, right? Be honest. If you are going to pay yourself extra and put it in a savings account and use it for a premium payment later. Or better yet, use it to front load the policy later. So if we're in a situation where we can put extra in year one to make that policy even work better long term, then now we have some extra money to do that and commit to a new premium payment. So the question I was getting was, what do I do with this extra money? Because you told us to pay ourselves extra. There you go. That is the answer to that question. The other question that I have gotten is, and I've apparently not clarified this, is how many life insurance policies can I have on myself? Just one? Do I have to buy a policy big enough to withstand my life? No. You can have as many policies as what the insurance company deems your human life value. So if you are, and you guys can write this down or whatever you want to do. Right now, if you are 40 and younger, your human life value is determined by 30 times your gross income. Gross income, not net. Gross. Before you have depreciated anything, before any expenses are paid. So if you make $1 million, you are worth $30 million. Okay? 30 times your gross income. If you are 41 to 50 years old, it's 20 times your gross income. 51 to 60 years old, it is 15 times your gross income. 61 to 70, 10 times gross income. And over 71, 5 times gross income. So you can have as many policies as what that human life value is. So for example, if your human life value is $1 million, you can have 2 $500,000 policies, right? 2 policies that are $500,000 a death benefit. If you want 4 policies, great. That's $250,000 a death benefit each, or whatever the numbers are. So the insurance company always asks us, what else do you have for life insurance? And that's why it's important. Even policies that maybe mom and dad own on you and bought on you as a child. Business partners that maybe have policies on you. All of that determines how much death benefit we can get in policies that we're looking at for you. And so if you have a policy that if we're going to go over human life value, which is very rare, but if we're going to go over human life value, then we can't put as much money in. But you don't have to start $1 million worth of policy today if you can't handle that, right? I mean, people in their 40s could be worth $50 million based on gross income. Like farmers have tons of gross income. So if we're looking at gross income and you're worth $50 million, chances are we're maybe not going to hit that number. So we just want to make sure that we don't go over that, but you can have as many policies within that number as you want. You can start them throughout your life. Now, the other question is well, is that my human life value forever? No. As you make more income, your gross income goes up, and now chances are your human life value went up, right? Now, the difference is like, let's say at 40, you make $1 million and you're worth 30 times your gross income. And at 41, you make $1 million and it's only 20 times your gross income. And so in that short time frame, our human life value actually went down. And that can happen if we lose money, or that can happen just by the factor of what we are figuring it to be. But if we're over your human life value, then we can go to somebody else's human life value. Now, what if I don't work? What if I'm a stay-at-home mom and my husband is the one with the income? Well, you then are allowed, and it's a little different in every situation, or it can be different, but you are allowed half of what your spouse has for death benefit. So if your spouse has $3 million, you are allowed $1.5 million. The other thing that we need to look at, especially when I have farmers, is she might say, well, I'm not working off the farm, I'm helping farm. Okay, so then if he dies, her gross income is going to be the same. And if she passes away, his gross income will be the same. The net income might not be the same, but the gross income is going to be the same. What happens if he's a partner in a farm with dad and the wife doesn't work? Well, does the wife then assume ownership of his percentage upon his death? If so, now can we use that as justification of her gross income? And so there's sometimes in situations we have to kind of figure out, if we don't have any gross income, where do we get the gross income from? How does that all work? Yada, yada, yada. But nonetheless, you can have more than one policy on yourself. It just depends on human life value, what that value is placed on you. And I've done podcasts about this before. Most people are not insured to their human life value. I had somebody just the other day say, well, we don't need more than $50,000 of death benefit. What? That is peanuts. And once again, my response was, so you're just going to get up and go to work the next day? Like, your spouse doesn't die and you go, oh, well, I got to go outside. I got a farm. I got cows to feed. Yeah, no big deal. No. That's not how that works. That is not how that works. So death benefit is important. And that is why the insurance companies say, that's how much you should have. That's how much your spouse is going to need if something happens to you. Because they're not going to insure you for $1 more than what you're worth. Insurance companies have to have a very good reason to ever go over human life value. A very good reason. Kids, we are seeing children under 18, their human life value is $1 million. That's as much as a life insurance company will go. There are lots of times that we have people that want to put insurance on kids and the premium buys so much death benefit because they're young that we get over $1 million. We can't do that. The most we can go on a child is $1 million, but they can only do half of what mom and dad have. So if mom and dad have $1 million, I can only do $500,000 on the kids. If mom and dad have $2 million, then I can go up to $1 million. If mom and dad have $10 million, I can still only go up to $1 million on a child. And the reason why is because we don't know when a kid is 3, 4, 5 years old, we don't know what kind of adult they're going to be. Are they going to be an alcoholic? Are they going to be contributing members of society? What are they going to do? Why should we insure a child for $10 million and he is not going to be worth $10 million in his lifetime? So the insurance company is very particular about not overinsuring people. They're not in the business of losing money. Remember, they need to be here 121 years because that's how long these policies go. Those were my two big questions that I have heard the last couple of weeks, and I love it. I love it when you guys email me or call me and say, Mary Jo, really? What in the heck were you talking about? Because I might not know. I might not know what I was talking about, but I'm happy to answer the question. So keep them coming because I like them. If you guys are on Facebook still, so many people have left Facebook. If you left Facebook, if you are still on Facebook and you are not following our Farming Without the Bank page, please do that. I did a live video that I talk about a client that I had visited with that was a board member of a bank. And you are not going to want to miss that story. And I'm not going to get into it here because this is already getting so long. But you're going to want to go there and listen to that story. Also, if you are a client of ours, we have a Facebook page just for clients. If you are not in that Facebook group so that you can talk to other like-minded people and surround yourself with other like-minded people, please email Mary Jo at Without the Bank, and Carrie will make sure that you get added. Okay, we are trying to add everybody, but we have to do it with email. And if we don't have the right email address, you're not getting into the group because it's a private group. And so please let us know so that we can get an invite out to you and that you can get added in there. If you are not on Facebook, I'm sorry. I don't have another group. We're really trying to get that group active and get people talking and communicating. And I know farmers don't have a lot of words to say. And I know that you guys don't want to be active, but it really, really is a good place to connect with other people. So let us know if you need to be added. Otherwise, if you've not gotten the book, Farming Without the Bank, if you've not gotten Nelson's book, Becoming Your Own Banker, the question is why? What are you waiting for? Go to farmingwithoutthebank.com, grab that book, grab Becoming Your Own Banker, and then be on the lookout for Life Without the Bank. That new book of mine is coming out very shortly, and we are hoping to have it out within the next 30 days. So be on the lookout for that, and I will probably talk about that one a little more in another podcast. But as of today, I'm done, you guys. Done. If you need anything, you know where to find me, Mary Jo at Without the Bank. Until next time, have a absolutely fantastic day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.